Michael Burry has been an infamous investor ever since the film The Big Short was released, detailing his moves to short the housing market in 2008. But his history of calling out bubbles and making millions of dollars in the process far predates that, and he's kept on going since then as well. In the wake of the COVID pandemic, Burry once again put his skeptical hat on and shorted the markets. And after a bleeding 2020, with stocks losing value week after week and month after month, few are brave enough to still claim he was wrong. He has, though, designated a new target, and this time it's the bubble surrounding index fund investing and passive investing, and he's going all out once again. Today, we're going to establish just what he's claiming, why he's making these claims, and what it all means, as Burry is telling us that the passive investing bubble has already popped. We just don't know it yet. Now, passive investing, for those who don't know, is the opposite of active investing. Instead of actively picking stocks, trawling through financial statements and future growth reports trying to work out which companies will do well in the future, you simply put your money into a broad basket of stocks and trust that on average, the value of all those companies together will increase. But Burry thinks this is a problem though, and that it's what sets this current market apart from previous bubbles. The difference between now and 2000 is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other, and still the door is only so big. Too many people have just sat around following the age-old investing advice of chucking a few $100s into the S&P 500 each month, and these people are all unaware of the problems this has caused. At some point, the rout will start, and people will start to liquidate their positions, but the door is only so big, as Burry says, and not everyone can get out alive. But Burry isn't just posting cryptic tweets warning us of what's to come. About a year ago, he actually posted a link to an academic research article called In Search of the Origins of Financial Fluctuations. Despite its rather dull name, the paper is very interesting and supports the idea that there is a bubble from passive investing. Burry summarized the article by saying, if $5 incremental market value results from $1 added to stocks, and 90% of millennials, also known as future wealth owners, are in passive market vehicles, that 5-to-1 ratio will get much sillier in time. COVID didn't stop it, inflation might or not. He then followed up with, the first step is to recognize that 5-to-1 is not a natural ratio. It is the product of a paradigm. So what will continue this paradigm? What may reverse it? This is the knife's edge, because we are at 5-to-1, it may go to 100-to-1 or become negative 5-to-1, but parabolas don't resolve sideways. What Burry is talking about, and what that academic article he linked to proves, is that when you put $1 into an index fund, the nature of leverage, margin, and other forms of debt means that the index increases in value by $5, and thus a bubble is born. Now, Burry recognized this back in September of 2021, 3 months before the bear market of 2022 began and we saw the top, but even he didn't know exactly where this would go. 5-to-1 is not a natural ratio, it's a product of a paradigm, and that paradigm is the Federal Reserve, it is fractional reserve banking, it is fiat currency, and it is debt creation. But we are witnessing the changing of our monetary environment right now as we speak, with interest rates rising and quantitative easing being replaced with quantitative tightening. It's possible that this is the paradigm shift, that the inflation following the COVID pandemic is what finally breaks this crooked system. As Burry just said, parabolas don't resolve sideways. This will either melt up or it will melt down. Of course, there are other indicators you can look to try and identify a bubble from index funds as well. The most notable one being the Buffett indicator, named after none other than Warren Buffett himself. It's a basic principle, but there are a few different versions. Some claim it's the total value of all US stocks compared to the country's GDP. Some claim it's the difference in value between the S&P 500 or the Wilshire 5000 and the US economy, but what we all agree on is that it measures the valuation of American stocks compared to economic activity, and that indicator was screaming at us by the end of 2021. When stocks are expensive, when they're in a bubble, the indicator rises, and historically, it has held true. In the 20th century, the indicator would usually sit somewhere between 50 and 100%, but it rose drastically during the dot-com bubble up to 140% at its peak. Then, over the last few years, as quantitative easing and money printing have exploded, the indicator started to rise again, this time reaching a monumental high of just over 200%, the worst we've ever seen. Since the end of 2021 though, stock prices have been falling as we all know, and so has the indicator, but it's still sitting above 150% far higher than it had ever been before this bubble, indicating that the pain is maybe not over and that the passive investing bubble may still be in full swing. Burry's also put out some not so cryptic tweets lamenting the lack of sensible active investors these days. I get the sense in 2002 there were more value hedge funds than there are value investors today. From his point of view, value investors are vital for a functioning market as they actually determine what prices assets should trade at, and a lack of those investors means a lack of pricing pressure in the correct direction. Without them, a passive investing bubble and bubbles of other types are far more likely to emerge, and that's exactly what we saw over the last few years as those investors who were active concentrated on hype and growth, with the worst of them all being Cathie Wood, a woman who lived in the clouds and convinced herself that this time it really was different. Burry certainly thinks the pain isn't over and that there's more to come, and that passive investing will play a major part in the history books, or as he puts it, you have no idea how short I am. Now, if you've been paying attention to the markets, you've probably seen how badly stocks are performing this year, and you might be thinking about diversifying your portfolio, or maybe you just want to hedge against inflation. Well, if that's the case, then you need to hear about this video sponsor, Vaulted. Now, Vaulted is the best way for individual or even institutional investors to acquire physical gold with a great website and mobile app that makes it easier than it's ever been. They store and insure their one-to-one allocated gold in the Royal Canadian Mint. It's all certified conflict-free, and you can rest easy in the knowledge that you can request instant physical delivery of your gold holdings wherever or whenever you desire. Their prices are the best in the market because they store all of their gold at the manufacturer and they cut out all unnecessary middlemen. They don't charge any premium or spread when buying or selling you gold, and they are as transparent as possible, meaning there are absolutely no hidden fees. On top of all that, they even managed to put out a load of really interesting content keeping you updated on the world of gold. Now, if that sounds at all interesting to you, then I highly suggest you check Vaulted out. Again, that's Vaulted with the link down below in the comments and description. But many people listen to these claims and they don't really understand how there can even be an index fund bubble. From their point of view, index funds are supposed to ensure there aren't any bubbles. You just invest your money into the market as a whole, so no singular company like pets.com gets extra attention. There's no euphoria or emotion when it comes to investing through index funds, so the market should function appropriately and price assets reasonably. Unfortunately though, index fund bubbles can exist, and it's actually due to their nature, not in spite of it. While there is value to the idea that you don't pay attention to any individual stocks in the market with index funds, that also presents a massive problem. Tesla over the last couple of years is a brilliant example because of the size to which that stock has grown. It's no secret that many people think Tesla has been a bubble, and one of those sounding the alarm has actually been Michael Burry over recent years. At its peak, Tesla was worth around $1.3 trillion and was one of the most valuable publicly traded companies in the world, making up about 3% of the entire market cap of the S&P 500. That meant that when someone went to invest in the S&P 500, they were putting 3% of their money into Tesla whether or not they knew it. This contributed to increased buying pressure for Tesla, and that will all have caused its price to go even higher. Because this is being done through an index fund, none of these investors are partaking in price discovery at all either. So to them, it doesn't matter how much Tesla is worth, they will keep buying it anyway as long as they invest their monthly $500 into the S&P 500. At the same time as this was happening for Tesla, Apple was worth just under $3 trillion and made up over 7% of the entire S&P 500, and so it was also seeing huge amounts of inflows from investors who weren't paying attention to its price. These companies were getting bigger purely because they were already big. They were getting more investors purely because they already had investors. There was no element of price discovery from the billions of dollars flooding into these companies via index funds, and with no price discovery, we see bubbles grow. Of course, this also happens across companies of every single scale, and it also affects every single company in the S&P 500, as it's such a dominant index. No matter where you go for advice, people will tell you the same thing. Invest in the S&P 500. So any company in the index is just going to innately have more attention and more investors and more buying pressure than a company outside the S&P 500 would have, and so we see their values grow. These inflows create strong returns, and that pushes further investment, pushing the value of the index up further again. And so it isn't even just the case that index fund investing can cause and create bubbles in individual stocks, but it can actually lead to a bubble in the entire index itself, and that's what many fear we saw in the post-COVID environment. With millions of people sitting around with cash burning holes in their pockets, they turn to easy to use and fun investing apps like Robinhood and put their money to work. Index funds and their popularity has never been so great, and so we saw the growth of the world's first major index fund bubble, at least according to Michael Burry. Now, at the end of 2022, and we've all been watching the markets decline all year, it seems incredibly likely that we're watching the first ever index fund bubble crash. Thankfully, the nature of index fund investing is far more passive than other types of investing, so fewer people cash out when fears strike their hearts, and that's likely why this bubble hasn't exactly popped. Instead, it's just been deflating. What comes next is anyone's guess, but from Burry's point of view, the markets will continue to fall, and so far, he's able to add another ribbon to his chest of medals from correctly predicting market bubbles and making himself a hell of a lot of money in the meantime. Unfortunately though, Burry is also pretty clear about how fast he thinks this is going to go down as well. As he said, all theaters are overcrowded, and the only way anyone can get out is by trampling each other, and still the door is only so big. From his point of view, once the recession really kicks in, when people start to lose their homes, their cars, and their jobs, when they have to make the tough decisions to go hungry or go cold, well, they will liquidate their portfolios and sell their passive investments no matter how much they've lost, and that will trigger the final collapse of this bubble as it culminates in the same way all bubbles do. Some people aren't convinced by this argument. Some claim Burry is a one-hit wonder and doesn't actually know what he's talking about. Some claim he's predicted more crashes than he's ever seen, but most are just cautious and worried because the economic environment growing right now is bad and it just keeps getting worse. Maybe the bubble has already popped and we just don't know it yet. If you want more content like this, then like, comment, and subscribe to the channel. If you want to hear my pure, unbridled opinions untainted by YouTube's ban hammer, then check out Stoic Financial Freedom in the link down below. And the first 3 people from this video can use code BURRY for a cheeky discount of up to 15%. So until next time, stay stoic.